Hello and welcome back to the fixed income securities series of NISM. Let's continue the next chapter that is credit risk, chapter 3.1.4. So bonds are essentially certificates of debt, or in other words, loans from the investor to the issuers who promise to repay the principal amount with periodic interest or coupon payments. Particularly for bonds issued by non-government corporates, the price of the bonds depends on the credibility of the corporate issuing it and often offer a high yield than the risk-free government bonds, as the investors are at a risk of losing their capital if the financials of the issuer deteriorate. The spread between government bonds and the corporate bonds of various classes indicates the level of default risk in corporate bonds. Types of credit risk include downgrade risk and spread risk and default risk. Chapter 3.1.4.1, that is downgrade risk. So, a company's ability to operate and repay its debt issues is frequently evaluated by the credit rating agencies. Downgrade risk arises for investors when the rating of an issuer is lowered after they have purchased its bonds. If a company's credit rating is downgraded by a rating agency on account of deterioration in its financials, the issuing company faces higher costs for raising new resources. The company's existing bond holders face a drop in the price of their bonds as the cost of funds for the company increases in the market. So the cost of borrowing for the non-banking finance companies increased drastically after the ILFS crisis, as these entities were finding difficulty in getting the funds from the market. The rating companies downgraded the rating of the securities issued by ILFS to junk category, as the risk perception increased and uncertainty of NBFCs fulfilling their promise of repayment increased. The cost of funding increased dramatically, hence increased default risk increases demand for risk premium in the market for corporate sector. As discussed earlier, each credit rating such as AAA, AA, or A, etc. represents a level of credit quality, and ratings are changed periodically as a company's situation improves or debt rates. So, given enough in historical data, the likelihood is calculated that a company at a particular rating will mitigate to a different rating over some time period. A rating migration matrix gives some idea about possible default due to downgrades. It also gives the possibility of rating migrations in various classes of bonds in a country. For example, the table below shows the average transitions in corporate ratings over a 40-year period. The diagonals are very important to investors as it indicates the percentage of companies retaining their ratings. Chapter 3.2, that is average 1 year transition rates from 1970 to 2010. So this is the category, the credit rating of a company that is going from AAA to CA or C. So it is migrating to AAA, AA, and then it's going to default. So the chance of a rated company migrating from AAA to default is 0%, but it is at least 3.336% to WR category, and there is a 8% chance that it will go from AAA to AA category. Of the chance is 8.62%. Chapter 1, 3.1.4.2, that is spread risk or basis risk. So a corporate bonds or non-government bonds pay a spread that is depending on their credit ratings over comparable government securities to compensate investors for the higher risk. The spread keeps on changing dramatically as per the market conditions and the performance of the company. Poor performance means the company would face cash flow problems and may not be able to meet its obligations of interest payments and redemption payments. This would make the company's debt very costly. The spread over comparable government securities would change, keeping in mind the possible default of the company. In tight liquidity, the situations or when the general market conditions is bad, the risk appetite drops in the market and the spread increases. The spread charged for higher rated papers would be far lower compared to the lower rated papers in the market. The chart below depicts the behavioral of spreads in the Indian markets in response to various stress conditions. So this is chart number 3.3. Here we have x-axis that is of spread that is going from 50 to 250, and on x-axis this is y-axis, and on x-axis we have the time period from 18 April to July 2020. So this is the period of COVID-19 outbreak, and these are the RBI measures. So we can see the spread is going too far, too low and too high, right? So what is default risk? Chapter 3.1.4.3. Default risk is the possibility of non-payment of coupon or principal when due. Default arises when the company fails to meet its obligations towards interest and principal repayments, while credit ratings help to measure and issuer's risk of default. There is still always a risk that some unforeseen event can force the issuer to default. The spread measures the default risk of a bond. If the market perceives an increased possibility of default for a bond, the interest rate for the bond would increase in the market. Junk bonds with very high credit risk or default risk generally pay high interest rate to investors. So that's the end of chapter 3, 3.1.4. We will cover the next chapter in next video. That's it for now. Thank you.